All right, welcome. The doors are open. People are starting to come in. Good to have you here. We're just going to give it a minute or so before we get started, just because it takes a couple minutes for everyone to come on in. So I'd like to welcome all of you. It's good to see you. Good to have you here. So come on in. All right, popping on in here. Excellent. Looks like I know pretty much most all of you. Okay, so in the respective time, it's 11:01. So I'm going to go ahead and get started. It's good to see you all here at 11 a.m. on a Wednesday morning for this special market update. I want to welcome you. My name is Jennifer Strong. For those of you that on the call that may not know who I am, Strong Financial Network here in Lakeport, and all of these beautiful faces on this screen are part of the Strong Financial Network team. And of course, Ryan, we've adopted him into our Strong Financial Network team as of today. So we want to welcome you all here for this special market update, and it's been kind of a wild ride the last couple of months or so. So we're really excited to have Ryan here with us today. So Ryan Detrick is actually the Chief Market Strategist for LPL Financial. We wanted to do this market update just because we have been seeing some volatility out there, and so we put out a request to LPL Research for someone that might be willing to come in and speak to all of you and to speak to our clients. And Ryan, basically the big cheese there for LPL Research, offered to do it, and so we are just super excited to have Ryan with us. So I'm going to be turning this over to him in just a second. But Ryan, just for those of you that didn't maybe see in the bio that we had sent out, he is the Chief Market Strategist for LPL. LPL has a team of over 30 research analysts that all they do is research on different companies and investment portfolios, and so they are a huge source of information and access to knowledge for us as we're helping kind of create these tools of portfolio for you. Ryan has he's been with LPL now. How long, Ryan?
Wow. Over 6 years. Time flies.
Time flies, and he's also, you may have seen Ryan out there. He was just on CNN Money about a half an hour ago. He's been on Fox Business News. He's been on MSNBC. He was on Bloomberg. Was it Bloomberg the other day?
Yeah,
So
Bloomberg Radio,
he
I think. I can't keep it straight, to be honest. There's always a camera in front of me, so I always have to remember, there's a camera always on, right? So, yeah.
camera is always on. So yeah, so you'll see Ryan out there, and I can tell you, I've heard him speak and have had the opportunity to talk with Ryan numerous times, and you are in for a major treat. Not only does he take all this stuff that is kind of complicated and make it so that you can understand it, but he also puts it in a way that's very engaging and exciting. So my recommendation to all of you is to hold on to your seats because he will get going on this, and you guys are going to learn a lot in the next 35-40 minutes. Y'all do have a question and answer box down there at the bottom of your screen. It says Q&A. Any questions that you have, go ahead and pop them into that box. I'll be keeping an eye on it for you. And also, into the chat, you can throw it in there as well. We are recording this session as well, so we will have it available for those that weren't able to join us on the call, and so we'll have that available after. But any questions you have, if you really would like to prefer to ask your question using your voice, you can always raise your hand and let me know, and we can unmute you. This is a webinar, so everybody is automatically muted, but you can pick any one of those avenues to ask your question as we go along. So with that, we're all going to turn our cameras off, and we're going to turn this over to Ryan. And again, welcome and thank you so much, Ryan. We are looking forward to hearing what you got to say about what's going on in the markets.
Awesome. Well, thank you, Jennifer, and thank you to the whole team for having me and inviting me. And thank you to everyone who's taken some time out of their busy day to kind of hear what's going on. We have a lot of stuff to discuss here. So we're just going to kind of dive right into it. Regis Philbin said, I'm involved in the stock market, which is fun and sometimes very painful. I think that's one of the best market quotes I've ever seen. Because honestly, last year, guys, probably felt pretty good, right? Stocks had a really good run. Hopefully your portfolios did pretty well. And then boom, this year happens. One of the worst starts to a year ever for stocks. We've come back a little bit, thankfully. But boy, January was rough. And if you were in some of the previous high flyers, that really have come back down to earth, and you're even feeling maybe a little bit more pain. But I love what Regis said again is the stock market's fun, but very painful. One of the key concepts I think that we're gonna discuss here is last year was really special. And what I'm going to show here on this screen is the max pullback you see during the year for the S&P 500. So guys, last year stocks pulled back 5%, all right, 5.2% actually, from early September to early October. That's it. Think about this. The average year sees a 14% correction. The average year that stocks are up, so when stocks finish higher for the year, you see an 11% correction. Volatility is pretty normal. I mean, honestly, we've been pretty spoiled by how strong stocks have done the last few years. 29%, 16%, and 27% returns the last 3 years for the S&P 500 without a lot of overall volatility. Of course, yes, March of 2020 was historic volatility, no doubt about it. But since then, guys, we haven't even had a single 10% correction. Now, to start this year, the S&P was down 9.8% just a few weeks ago. So very, very close to a 10% correction. But I think it's just such an important concept to realize that, markets go up, they also can go down. And it doesn't mean you should, kind of ignore, right, in essence, your long-term investment goals. You want to continue to work, with your advisor and continue to do the things that they're telling you to do to help you reach your long-term goals. But the truth, again, is it's going to hurt. There's a, what was the story? Give me 1 second here. Lawrence of Arabia, all right, movie Lawrence of Arabia, if you ever saw that. One guy takes his fingers and pinches the candle. Other guy looks at it and is like, I want to try that. Goes up to the candle, pinches the candle, screams in pain. He goes, how in the world did you do that? First guy says, you just got to know it's going to hurt. That is investing sometimes. I mean, it's not always going to be easy. It is going to hurt sometimes. I don't be all negative here. I'm just trying to lay the groundwork. We're still very bullish here. We still think stocks are going to do pretty well. Economy's pretty strong. But I just want to make it clear that, if we have another 10% correction this year, which honestly, guys, could happen, just be aware this is kind of part of the process, and be aware that these years can be more volatile. This is a midterm year, right? Historically, take a wild guess out of the 4-year cycle, the most volatile year in a midterm out of the 4-year cycle. Yeah, midterm years. Midterm years tend to be pretty rough early, and then later in the years, you closer to the election, after the elections, when a lot of the gains, historically at least, have happened. So those are some of these big picture concepts to be aware of. Now, 2020 was very bad, no question. 2021, though, was something all by itself. I'm going to share just for a couple minutes here some actual headlines that we saw last year in 2021. Circus clowns are the latest pandemic-related shortage in Northern Ireland. I mean, we're going to talk about the shortages and supply chains, but my goodness gracious, when you have a shortage of circus clowns, that's pretty serious stuff. This one's crazy. IRS reminds thieves and drug dealers to report their illegal income. I'm sure that that note was taken wisely by the thieves and drug dealers. And last one, my favorite. This particular, I'm going to call him a character. This character won $125 million. He took $200,000 of it in manure and stuck it on his ex-boss's lawn. And one glance at his mugshot, I think he's going to say it was worth every single penny. But we made it. By no means is the pandemic over. But just yesterday, right? If you look at the 7-day moving average of new cases, down 83% from the middle of January. Now we've seen this before, and then different variants and things have taken place. From Delta variant, obviously Omicron recently. But we're optimistic we're on the other side of this. We've all been through so much. All of you on this call have been through so much sacrifice. Probably tragically have lost someone that we know and love during this terrible 100-year pandemic. But we're on the other side of it. And there's Marty and Doc from Back to the Future. Kind of cool to see. I think we're moving forward. And speaking of moving forward, George Burns told us, I look to the future because that's where I'm going to spend the rest of my life. I think that's a pretty cool quote, big George Byrne fan, and we're going to do that right now, where we look to the future. There's a picture of a Ryan Detrick from 6 years ago. I started with LPL 6 years ago in January. I'm going to assume that picture was taken about 6 years ago. I've got a 14-year-old daughter. If anyone has a 14-year-old daughter out there, if you remember, sometimes, I don't know how to word it, maybe they can be a little mean. Just the other day, my daughter was like, boy, Dad, you're looking really old. And I'm like, man, you try to, manage. My team manages $75 billion. I mean, we manage a lot of money. Clearly doing it through the pandemic. It was extremely stressful, a few more gray hairs, this and that. So I just like to leave this picture from 6 years ago, just to remember when I was very young and naive. And I will say I was hired as the senior market strategist, moved from Cincinnati, Ohio, down here to the Charlotte area where I am right now. I'm in a little town called Fort Mill, South Carolina. One of the fastest growing cities in the United States, under 20,000 people. LPL built a huge campus here, and that's where I'm sitting right now. But I was hired as the senior market strategist, and I was recently promoted. I'm really in the middle of the pandemic, to be honest, to chief market strategist. So it's not lost on me how kind of lucky and fortunate I am. And hopefully most of us on this call have been, lucky and fortunate. It's been terrible what's happened, but a financial company like LPL, one could argue, we've actually grown faster because of everything that's going on. LPL manages total of 1.2 trillion in assets. If you look at all the 20,000 LPL advisors around the world, it's an honor and a delight to be here today and to help our advisors and help their clients. So that's what I love to do. So passing the baton, where is my baton? Here it is. Here's my baton. We have a YouTube channel. You can go to LPL Research YouTube, find it pretty fast, Google it, right? And I did a fun video on there about passing a baton. I'll just leave it at that. You can go watch it. I'm throwing the baton in the air, trying to catch it. You can imagine how that turned out. But the theme to our Outlook 2022, and I'll be very clear here, we started writing this in October. October feels like a lifetime ago. Now, what I'm sharing today is, yes, a lot of the big concepts we shared then. This came out in early December, by the way, our Outlook. But the key concept we wanted to lay out there is the idea of passing a baton. How did we get to where we are? The truth is, hey, the government and the Fed did a lot. They had to do the things. Fed has had interest rates at 0% for the longest time, flooded the economy with money, expanded the balance sheet, all the stuff you've heard about. And the Fed's a touchy subject, and we'll talk about it soon here. But the Fed had to do that. It was a horrible 100-year pandemic and our economy shut down. The government, they literally gave people money, among other things. They had to do that. But now that we're on the other side of this and things are growing, just this morning, I don't know how closely you guys watch the news, retail sales this morning for last month came in way above expectations. All right, so congratulations all of us on this call, the consumers, right? So what I'm getting at, on one side of the thing, you had the government and the Fed driving the ship. I would assume most of us would agree we probably don't want that forever. I mean, we had to get to where we are, but it's going to be time for a handoff. It's time for the government and the Fed to stop, running everything, hand it off to us, the consumers, to corporate America, to small businesses, the capital expenditures, investing in yourself to help grow this economic cycle. And think about with the Olympics right now, right? If you're running really fast and you hand a baton, it's not as easy as it looks. The faster you run, you hand a baton off, what can happen? You can drop it, you're in trouble. We don't think that's going to happen, but it's a good imagery, right? This economy's chugging along pretty good. So this transition, this handoff, it's not going to be easier said than done, but we're pretty optimistic that the Fed and the government are going to take more of a backseat and let consumers and businesses kind of grow this economic cycle. And we're optimistic that's going to be a pretty good thing when all is said and done. So we'll talk about the economy here for a second. Little boy's on Santa's lap. He says Xbox. Santa says chip shortage. Vans, factory slowdown. Brats, raw materials. Lululemon, bottleneck at the port. Little boy says, I just should have been naughtier this year. Santa says we're out of coal too. I think that sums up last year just about as good as anything. I mean, every one of you on this call, we've all been impacted by this some way or another. Just stuff costs more. I mean, inflation data continues to come in really hot, right? I mean, oil is up to almost $100 a barrel. I mean, we don't need to go through it all. You guys know what I'm talking about. Just go to the grocery store. Things cost a lot more. I went by, where was it? I think it was Taco Bell just last night. And I didn't go there. I just looked by and they said new employees, $15 an hour. This is in TK, so maybe it's cheap where you live, but $15 an hour for, high school kid, that's a pretty good amount. I mean, we're all feeling it. You got to pay more money. That's kind of the whole issue with the supply chain issue and what the government and the Fed have done, but they had to do it. So now it's time to take the foot off the pedal of the metal. So let's just put it like this. The supply chain issues have been extremely serious, right? Just to get your goods and services took a while to get there. We are starting to see some really positive developments. If you look at things like manufacturing reports that come out monthly, time to delivery, input prices that are paid for raw materials, these things look like they've peaked and are starting to roll over. Now it's going to be, we're having dealing with these inflation issues likely for several more months, but we're optimistic by the end of this year, as these supply chain issues work their way through the system. What did GM CEO say? GM CEO a couple of weeks ago, General Motors, said, hey, by the way, I don't think any industry has been hit harder than the automotives, right? I mean, from the chip issues we've had all over Asia and Malaysia with the chip shortages, a car is just a big computer anymore is all it is. They've been hit hard. Guys, used cars are up like 40% the past year because you can't really get a new car necessarily, or it's hard to get one. So you're buying used cars. So if we start to see positive developments when it comes to cars, we're optimistic that we're getting, near the peak with the inflation worries, and we very well might have seen some positive steps in that the right direction when it comes to car prices just recently. But CEO at GM said second half of this year, they see full production back online. Haven't done that since pre-pandemic, right? So there are some real optimistic things coming that it's not minimizing the inflation and the problems we have. But again, the stock market's a forward-looking mechanism. It always is trying to price in the future here, and we're optimistic that there could be some better times coming ahead. Jimmy Buffett said, indecision may or may not be my problem. Maybe you've heard that song before. So here's a good one about economists, right? This is just a couple weeks ago. Companies unexpectedly cut 301,000 jobs in January as Omicron slams labor market, ADP says. 48 hours later, U.S. jobs growth surged 467,000 in January as economy weathered Omicron. Those are two different reports, but are you kidding me? Like, there's the old joke, why did God create weathermen? Why did God create weathermen? To make economists look good. I mean, it's tough to predict what the economy is going to do from a day-to-day, piece-by-piece point of view. But the truth, again, is consumers, us, are in really good shape. Corporate America, we're going to talk about earnings here soon enough, but corporate America has had a spectacular fourth quarter earnings season. Once again, revenue's been really strong. Just the confidence is in there. It's not pretty what the stock market's done to start this year off. When you put in perspective the rally that we've had, the underlying pinnings of the economy are still healthy. So where do we see things, guys? We saw about 5.5% GDP growth last year in the U.S. What's GDP growth? That's your gross domestic product. That's kind of your economy, right? Goods and services sold in your economy. Well, it's going to slow down this year between 4 and 4.5%. And I'll be honest with you, we did that in October. We probably don't hit 4.5% GDP this year, maybe 4%. The first quarter is going to come in a little light. We didn't totally expect because of Omicron, but still, we're optimistic the economy is still going to grow 4% this year, let's say. That's really good, right? Especially after last year was the best year of growth since 1984. Again, taking your foot off the pedal a little bit. That's okay. Global growth is strong as well. So things are not perfect, but again, that's a pretty solid backdrop for economic growth, with inflation likely by the second half of this year really starting to come back down. And that's you guys see the same things that I see. All right, these sentiment polls that are out there, what the consumers are saying, what our CEOs saying. It's the continued worry about inflation and wages. I mean, everybody wants to make more money. I think for the most part we do. But if you're a company and I see it with my team, right? We could hire this person, we could hire that person. Then they want to work from home. They don't want to come in the office. They can just stop working with us at LPL and go work for Wells Fargo for 10% more. I mean, there are some things that are they're very difficult. That really have no easy answer, to be honest. Kind of on those fronts. But again, big picture, if we see some alleviation with the prices on autos, if we see some alleviation with the supply chain issues that we're seeing in China, Malaysia with the chips, these things are kind of a domino effect that eventually are going to work its way through the system. 6 to 9 months from now, we can see some major improvements, if you will. Also, don't forget, I mean, last year the economy grew almost 6%. Inflation was up almost 7%. So that's a big number of inflation. But when you start to, you tend to have more inflation when the economy is growing faster. If the economy is starting to slow down a little bit, which is okay. It's not stopping, it's just slowing down. Inflation likely comes along with it. So speaking of the economy, the last couple economic cycles of growth are what I'm showing here now since World War II, how long they lasted. The last one lasted 11 years. So that's when the economy is growing without a recession. March of 2020, the recession started, only 2-month recession. So this new economic cycle of growth is less than 2 years old. Okay, I think it's in May or so is when it'll hit 2 years old. The average cycle of growth has been over 5 years. We think there's nothing wrong with being average. We think we can hit average here and have 5 years of economic growth in this cycle. Again, there are still major tailwinds. I mean, the Fed interest rates are still 0% last I checked. They're going to start hiking rates. We're going to talk about that next. But the Fed's still a tailwind. I mean, the government's had so many different the trillions of dollar infrastructure plan that we just had last year. Those are a lot of that money is going to be spent into the future. So a lot of the stimulus that we've had, we haven't even seen yet, right? It's just been, we signed and delivered by Washington, but the stimulus is still coming into the future. So this economic cycle still probably has many years left of it. Will we go to an 11-year cycle of growth? We don't think so. Like the last one. I mean, again, it wasn't your average recession, right? Certain businesses like financial company, for instance, did actually really well. Right? What if we were a cruise ship or airlines or hotels, kind of the epicenter of this? Clearly, it'd be a little different story. But just be aware these cycles can last a while. Now, here's a joke I like to use. There's a statistician, and he put his head in a bucket of ice and his feet in the oven. They said, "Hey, how do you feel?" He goes, "Well, on average, I feel pretty good." So I like that one. Alan Greenspan, you've maybe heard of him. He was the guy in charge of the Fed in the 80s and 90s during a really good run. He said, "I guess I should warn you, if I turn out to be particularly clear, you've probably misunderstood what I've said." I love that quote by Alan Greenspan. Alan Greenspan would talk for like an hour. Nobody would even understand what he just said. And then he'd be done. Everybody look at each other like, "Oh, I guess that was pretty good." That is not the Fed right now. Jerome Powell's in charge of the Fed now. Jerome Powell is the first non-doctorate person to lead the Fed in like a generation. I like that because, again, he's more real world, right? He's not so much Wall Street. He's more Main Street. And I think there's some positives there. Has he done a perfect job? No. But we're really impressed with kind of some of the job Jerome Powell has done. Now, also, let's be honest. I like him because he's straight up front, right? For the longest time, they being the Fed, were worried about the employment backdrop. They kept rates low. You could argue maybe a little longer than they should have, but they really wanted to make sure after a 100-year pandemic, the worst recession since the Great Depression, we're on pretty firm footing. Now, starting in November, they kind of changed that. Late November, they changed it. Now, we're worried about inflation, rightfully so. So what does that mean? Well, the Fed can do some certain things here. And this is a great quote to sum it up. William McChesney Martin Jr., actually doesn't have Jr. there, but that was his name, former Fed chairman for almost 20 years. He said, "The Fed's job is to take away the punch bowl just as the party is getting good." So I think that's a great quote. And there's some truth to what the Fed is doing. They are taking away the punch bowl, right? They're going to start hiking rates very soon. There's going to be a Fed rate hike in March in all likelihood. It's darn near certain. We can't make guarantees in this industry, but it's about as certain as anything we're going to see. The Fed has said that. So that's being priced in. The Fed might do a couple different rate hikes this year. That some people, Goldman Sachs is saying the Fed might do 7 rate hikes this year. We're a little skeptical they're going to do that many. But again, they have to take the punch bowl away. Now, there's something called the Fed balance sheet, and maybe you've heard of the Fed balance sheet. It's when the Fed buys bonds, right? The Fed was buying $120 billion worth of bonds every single month during the pandemic. They started buying less and less and less. What the Fed is potentially going to do sometime later this year is that balance sheet that's about $8.5 trillion. They're going to start to let some of those bonds run off. So in essence, the Fed won't own as many bonds. And that could be another way that they're taking the foot off the pedal to the metal and potentially can help with the runaway inflation that we're seeing. Now, just be aware, though, this is still a tailwind. It's widely assumed that about 3 or 4 years, the balance sheet will be cut in half approximately. So call it 4 trillion. That's still a really, really big balance sheet. And again, still we'd say more of a tailwind than not. Is it a headwind? Is it not? It kind of depends who you ask. And here's what we think on that. What happens when the Fed hikes rates? Again, this upcoming middle of March, the Fed's probably going to hike rates for the first time in a long time. And they should. I mean, when you hike rates, it's like taking off the training wheels. Everyone's freaked out because we have 0% interest rates. With an economy as strong as this one, we do not need 0% interest rates. A lot of that is kind of partially why inflation is as high as it is, because you're still juicing things pretty good, and things are already pretty good. So you don't need that much. Now, what we're sharing are all the times the Fed hiked rates during the first hike in a new cycle. Look at 3 months later. I see some red there, some volatility. December 15, the Fed hiked rates. Market went like straight down into the middle of February as it kind of recalibrated what the rate hikes might mean. Check out 12 months later, though. After the first Fed rate hike in the last 7 cycles, stocks were up 6 of those times with a 9% return. Pretty solid. Here's the key concept a lot of people don't really understand. When the Fed hikes rates, that's more mid-cycle. What in the world does that mean? It means you're not close to a recession is what it means. It's taking those training wheels off. The Fed starts hiking rates. The Fed hiked rates, guys, 17 times in 2004, 5, and 6. You know what stocks did? They gained every single time. And I'm aware 2007 was the peak, and I know 2008 what happened. But, we've seen previous times when the Fed has hiked rates. Yeah, more volatility, but stocks in the economy do well. Here's another way of showing it. We took a look at all the times they've hiked rates. The stock market peaked like 3.5 years later. 3.5 years after the first hike. The first hike would be March. Could the stock market peak 3.5 years from now? Of course, I have no idea. But I'm just saying, to quote Jim Carrey, you're telling me there is a chance. That's kind of the thing you need to be aware of. Now, it's a very touchy subject, and trust me, during Q&A, if you want to ask more questions about the Fed, we can do that. The Fed is not perfect. Jerome Powell's not perfect, but I think it makes sense that they did what they had to do, and now that inflation is still stubbornly high, I guess is one way to put it, they have to really take their foot off the pedal to the metal. But when they start hiking, just be aware. You look at history, and the economy is still really strong. Those are some positives. Last thing on this, let me get one drink of water here. Herbert Hoover said, "Blessed are the young, for they shall inherit the national debt." We're going to talk about debt for a minute or two, because every time I present, it comes up, and it's a very big issue. Our country, congratulations, just cracked over $31 trillion worth of debt. President Biden joined an illustrious group of every single president going back 100 years to increase the debt ceiling. Whether it's right or whether it's wrong, I'm just going to kind of tell you the facts as we see it. The truth is, our country's had a lot of debt for a long time. What I'm showing here, Time Magazine, is the U.S. going broke. That's 50 years ago. All right, so 50 years ago, we were worried about going broke. The way we look at it is this. Yes, our country has a ton of debt. Is that good? Is that bad? I think it's hard to say it's good. But the truth is, maybe it acts like an anchor, okay? You think about it. Last decade, and even in the best years, we barely saw 3% GDP growth. Maybe all that debt kind of acted as an anchor. Now, here's the glass half full type of scenario. What if instead of having a 5 or 6%, for a couple of years growth, you have 7 or 8 years of 2 or 3% growth, right? It continues to kind of just let the cycle go a little bit longer as the economy ages. And that's kind of where we are with all the debt. Now we're getting to the other side of this. Once you get out to 2023, 2024, the debt absolutely could kind of hold back the economy to a degree, but it doesn't mean you have to go into recession, and maybe the cycle lasts a lot longer. Think back to March of 2020, if you want to. The stock market was killed. The bond market, honestly, was killed outside of like long-term treasuries. Let's see, gold was killed. You guys know what went up in March of 2020, if you remember your history? The US dollar. The cleanest shirt in the dirty laundry. It was a reminder to us and the rest of the world that we have the world's reserve currency, right? And again, cleanest shirt and dirty laundry is the best way to put it. But when the you-know-what hits the fan, people flock to our treasuries and they flock to our currency. That was a reminder to the U.S. and the rest of the world that, hey, do we have to play by the same rules as everybody else when you've got the world's reserve currency? I'm going to say maybe not. And that's just the truth, right? When you have that, hopefully everyone on this call who hears my voice, we will still have the world's reserve currency when we're all long gone. All right. And again, that's just a nice thing to kind of be, a nice thing to have, I guess is what I want to say. Now think of it. I was going to point out one more thing. Oh yeah. Think of it like this. That's the U.S. Look at corporate America. Balance sheets are really healthy. Companies are really growing. Look at individuals. Look at consumers. I mentioned that consumer number this morning, really strong. Yes, people say, oh my God, there's like record credit card debt. Yes, but it's denominator blindness. It's because wealth is so much higher. So of course you're going to have a little more debt because your net wealth is up so much. Our country, recent data by the Fed, I think it's $147 trillion worth of wealth. A lot of that sure is because of houses. You own a house. You guys, I know a lot of you in California, right? I mean, you own a house. It's probably up well over 25% last year. Okay. Here in Charlotte, it's going bonkers. I'm glad I moved from Cincinnati to Charlotte when I did, because my house is worth a ton more money where I'm sitting. So we're all worth more, not all of us, but most of us are probably worth a lot more money because stocks have gone up a lot and your house has gone up a lot. That's a good thing, right? So again, I call it denominator blindness. So just to widely say, oh, there's more debt, it's a bad thing. There's also more equity and wealth that's out there. So just some important concepts. Last little rant on this, and then I'll stop. So in 1972, the US dollar and gold were pegged to each other. John Connally, Treasury Secretary for Nixon, severed that distinction between the dollar and gold. And now it was worth $1 because we say it's worth $1. That's how it worked. Global bankers hated this decision because it wasn't really advantageous for them. As legend has it, Connally said, you know what, it's our currency, but it's your problem. Right or wrong, that is how the United States has viewed debt ever since. Yes, $31 trillion does not make me comfortable for our country to own that much debt. But when I look at the balance sheets of consumers and of businesses, that's what you guys, for investors and how the economy is going, I think that matters more for all of us than what the U.S. debt is doing, because we've had a lot of debt for a long, long time. So let's talk a little bit about stocks. What am I doing here? I just start talking and don't shut up sometimes. So hopefully I can wrap this up about 10, 15 minutes and we do Q&A. Staying in the zone is what we called it. So let's see, there we go. It's not me who can't keep a secret. It's the people I tell who can't. Honest Abe. I don't think that's a real picture of Honest Abe, but I like his glasses. So what I'm going to do today, we're going to talk a little bit about secrets. Secret number one, I kind of talked about this already. Midterm years can be rough. We've been talking about this for several months now, and sure enough, this year's pretty rough so far. The average midterm year, as you can see on your screen, pulls back almost 17%. Check out what happens a year later, up 32%. So you're going to call Jennifer, you're going to call the team, you're going to be worried if you have a 17% correction. And you should be worried. This is your money, this is your livelihood. You should be, well, not worried. Maybe concerned is a better word to use, because what we're trying to lay out here is expect some volatility, but also expect, hey, no pain, no gain. That pain, look what happens a year later, right? I mean, it could be an opportunity. I was reading recently Pavlov and Pavlov's dogs, right? You ring the bell, the dog starts to slobber. You've all probably heard that story. I do the exact same thing when someone tells me it's time to eat. There was a horrible flood at Leningrad, and some of the dogs tragically died. 2 weeks after everything was done, or everything was cleaned up, Pavlov started his experiments again. He rang the bell. Do you guys know what happened to the dogs that were there? They did not slobber. He deducted 100 years ago, and I think rightfully so, that in times of extreme stress, in times of extreme fear, in times of just when things are really, really bad, you know what our brain does? Our brains are wonderful things. It short fuses and does not work. We make the absolute worst decisions when we're under stress, and that's just how it is. Now, there's no worse or no problem. I'm going to say this, fairly comfortably. I don't think any of us were probably more stressed about things in general than March of 2020, when the stock market's getting killed, people are dying, people are getting sick, we didn't know what was going on. That was about as much stress as anyone's going to feel, hopefully, in our lifetime. A lot of people made some investment decisions that maybe didn't really work out so well because they kind of sold, and then you see stocks have gone up so much. That's why it's so important, for all you guys, by the way, you're really lucky, right? I mean, for the team to reach out and have me come on, maybe not lucky to hear me talk, but you're lucky that your team cares about you, right? That to have these webinars and have these different speakers that come in and do some of this stuff. But I think the key concept of anything you listen to that I talk about today, it's that midterm years are pretty rough. After a big rally, you can expect volatility. When the Fed start hiking rates, you can expect volatility. The economy's getting older, expect volatility. That doesn't mean the bull market is over. That doesn't mean we're going into recession, though. And just be aware, a year later, check out those returns. So it's concerning if we have more weakness this year. We very well could, but just be aware, it's kind of how midterm years tend to play out. This is a pretty cool chart. I mean, a lot of numbers on here. I just looked at all the 10 to 15% corrections the S&P's had since 1980. Again, we nearly had one. We corrected 9.8%, but just a big picture thing. Look at 1 year later and look at 2 year later. 1 year later, up 23%, 90% of the time. 2 years later, up almost 40%, again, close to 90% of the time higher. Pullbacks are going to happen, right? You're going to be scared. Our brains are wired a certain way. It's just how it is. But just like print this and save this, and I can get this presentation to the team, and you guys can get this. It's client approved, so feel free and print it off and save some of these charts. But again, if you get these pullbacks, it's usually a pretty good time to potentially at least to not panic. I'm not saying you got to go all in, but at least don't panic and use the opportunity. There's an old saying: the stock market's the only place things go on sale, but everybody runs out of the store screaming. I think there's some truth to that. Another positive from a contrarian point of view. What did Churchill say? Churchill said, if everybody's thinking alike, somebody isn't thinking. Right now, people are, after this big pullback to start the year, especially some of the high flyers. I mean, honestly, guys, if you guys had portfolios in just energy and financials, I'm doubting if you did. I'm just throwing out, the examples. If you're just energy and financials, you're feeling pretty good right about now. But if you've got some other areas of the stock market, and hopefully you do, because you should have a diversified portfolio, you're feeling a little more pain. But check out these recent magazine covers. The Big Chill, a bull stuck in the snow there, and then the When the Ride Ends, talking about what happens if the market crashed. Those are recent magazine covers. That's market sentiment. Again, if everybody's thinking alike, somebody isn't thinking. We love to see kind of negativity because, again, from a contrarian point of view, that can be a positive. When everyone left is bearish and sold, the only thing left to do is buy. And we think we could be pretty close to a scenario like that in general. By the way, with stocks, we do think the S&P, which is down, I think, 5 or 6% for the year as we speak, approximately. We think it can still get up to 8 to 10%. I know it feels like a long way away, but we've seen this before. In 2015, when the S&P, when the Fed started hiking in December of 2015, stock market got killed into early February, and we still had a really, really nice year that year. And every year is different, we're aware, but just be aware that there are some similarities. Mark Twain said, "History doesn't repeat itself, but it often rhymes." I love using that quote, and there are some similarities with now and 2015, early 2016. So my son Gus is 9. When he was about 7, we're driving around down here in Charlotte. Hopefully you guys have heard of Kentucky Fried Chicken, KFC. That's the Colonel there. My son today, "Daddy, you see that guy up there?" I'm like, "What are you talking about?" He's like, "That guy up there." I said, "Oh, the Colonel." Now, growing up in Ohio, southwestern Ohio, we ate KFC a good amount of time. A big fan of it. And I said, "Yeah, it's the Colonel." He goes, "Hey, Daddy." I go, "Yeah." He's 7, by the way. He goes, "Why is his body so small?" Almost wrecked the car. And I'm like, oh my God, he's right. Like, I grew up thinking that's just a funny Southern tie. A 7-year-old looked at it and immediately said, "Why is his body so small?" So now I've ruined it. Every time you see the Colonel, you're going to think of that. But it's all about our perception, right? It's all how we see things. We all have the same information, but we come to wildly different conclusions. Best example, around Thanksgiving table, bring up politics, right? We've got the same info. Everybody's got a different opinion. Maybe don't do that. Actually, that's the one thing you should listen to when I talk about. Don't bring that up at Thanksgiving. And remember, markets can be volatile. So anyway, what's one thing that I kind of think we all can see and get a different perception on is interest rates going higher, yields going higher. The media world have talked about how the 10-year yield's gone up this year, and that's bad for stocks. They talk about how it's bad for technology companies. And it's been bad lately, yes. But what I'm sharing here are all the previous times the 10-year yield went higher. Check out what stocks did. Since the mid-90s, they've been up every single time. I think a key concept is it's the bond market's way of saying if you have yields going higher, the economy's on pretty good firm footing. I think it's that simple, right? And stocks should do pretty good when the economy's on firm footing. That's how it works. So again, higher rates aren't bearish, and that's something I don't think a lot of people realize. So the 10-year yield continues to kind of gently go higher here. It's up around 2% as we speak. That can be a positive really for stocks. Another positive is this is a mid-cycle year. What in the world does mid-cycle mean? It means you're not near the beginning, but you're not near the end. We don't think we're near a recession. We're not near the beginning. It was 2 years ago. Look at the shaded areas on your screen. Those were mid-cycle years. 80% of the time, the stock market's up. 11.5% gain on average when you have a mid-cycle year. Doesn't mean you have to have spectacular gains. In fact, last year, let me see if I got the chart here. Okay, no, I don't. Okay, good. So last year, stocks gained over 20%. Take a wild guess what happens after a 20% gain. The next year up 11.5% on average, higher the last 9 times. Last 9 times the S&P gained 20%, the next year was up. All right. So mid-cycle year, and I know it's been a rough start. We get that. But again, it's kind of when you put all these things together, it maybe has been an opportunity for a lot of investors who said, you know what, I'm going to wait and buy the pullback. I'm going to wait and buy the pullback. Pullback's here. We're having a pullback, right? I mean, there's a lot of good, solid financial companies. No, wrong word. A lot of solid technology companies that just kind of been thrown out with the baby in the bathwater that are down a lot because some of these previous high flyers have really come back down. So you can talk to your advisor before you make decisions, but just be aware that there could be some pretty good opportunities here for a lot of people before this year is all said and done. Another secret, geopolitics and stocks don't mix. Clearly, the Russia-Ukraine issue is extremely serious. The truth is this, though: if the economy is on firm footing, the stock market usually is pretty good in the eye of these terrible geopolitical events. We went back and looked at a bunch of them here, and we've got a blog, lplresearch.com. Check out our blog, whenever you want. Client-approved blogs on there, and I wrote this a couple weeks ago. Found all these geopolitical events. Check out the total drawdown, right? 5% on average. Yes, some of them were bigger deal than others, no doubt about it. But it takes just usually a couple of months to make up for those losses. So we're not minimizing what's going on with Russia in that part of the world and in Ukraine right now. But again, if there's some volatility, if something were to happen, would it start a new end-all be-all bear market for the United States? We said no, probably not. And it very well could be a potential buying opportunity for savvy investors. Hopefully there's some Seinfeld fans out there. Let's always, I was talking about secrets and lies and things like that. Let's always remember what George told us. It's not a lie if you believe it. Second to last one, then we're going to talk bonds and then do Q&A. Secret number 7, earnings are very strong. We're wrapping up fourth quarter earnings season. You all saw the Facebook, well, maybe not, but most of you probably saw the Facebook earnings. Facebook was down 26% on disappointing earnings. Yes, that was out there. Majority of corporate America has done amazing. We're looking at earnings up 30% year over year in the fourth quarter. A few weeks ago, it was expected to be up 21%. Revenue flirting with 15%. That's one of the best revenues we've ever seen. Now, historically, a little higher inflation likely means higher revenue as well. So that's kind of how it works. But still, that's a really solid revenue number. S&P 500 earnings last year were up about 50%. It's the blue there, you can see. Actually, it's U.S. earnings up about 50%. This year, expect to be up about 9%. Honestly, after the earnings that we've just seen, we think it's very likely that earnings hit more than double-digit returns this year in terms of earnings growth on the heels of last year's huge rally. And that's going to help justify stocks kind of where they are. So we still think, the S&P can gain between 8 and 10% when all is said and done. We do like cyclical value. What is that? Well, that's industrials, materials, financials, energy. Some of those things that the economy is growing, which you still think is the case. Those are some of the areas that the $75 billion that we run. Geeky word is tilts. We're tilting towards some of those areas, and we're optimistic there. We didn't like emerging markets much to come into this year. We actually just upgraded our view on emerging markets last week. The emerging markets or 2 weeks ago. The emerging markets are cheap. We're more neutral now. We still think the U.S. The U.S. is still our favorite area. We like cyclical value in the U.S. And when it comes to, and then we're more neutral, if you will, international. But there could be some opportunity there for international stocks finally. As yields keep going higher, it means bonds don't do as well. We'll talk about bonds soon. But financials and regional banks, some of those groups can do well. It's hard for me to think the world is about to end when I look at, which is what some people are saying, by the way. The guy I was on CNBC with last Friday, my goodness, this is like, he was very, very dour on the world. And I was like, oh, we don't see it. Anyway, it's what makes a market, right? But you've got very big financial companies, very large banks, Berkshire Hathaway, a little guy named Warren Buffett. I mean, these companies are making like all-time highs, like almost as we speak. All right, the market, if you look at history, financials tend to peak well before the S&P 500, before any trouble, right? Financials peaked way before the 2000 peak. Financials peaked way before the 2007 market peak, and they were weak. We're not seeing that. We're seeing financials strong. I mean, that's a major thing I think a lot of people just ignore. I've got a podcast called LPL Market Signals. LPL was the first broker dealer to have a podcast. Like podcasts, check it out. Our YouTube channel, we put it on there. These are the signals that we're looking for that tell us that, things are good or things are bad. Things are not great. I'm not saying that, but I'm just saying things are still better than not. And a lot of these positives that are out there, just a lot of people aren't paying attention to. Reason number 8 to be thankful. It's the year of the Tiger. I am from Cincinnati area. Now, this would have made a lot more sense had they won the Super Bowl. Still a little heartbroken. I actually probably got some Rams on the call, actually, given where you guys are, right? So hopefully some Ram fans there. So congrats to that. But still, it is the year of the Tiger. And just, again, don't invest in this. This is playful stuff. Historically, year of the Tiger, stocks have done pretty well the last few times. Now, the final secret, then we'll do bonds and then Q&A. If you ever see me on TV, hit pause at any moment, and I promise you I'm doing something stupid. Here I am on live TV playing an imaginary turntable. Here I'm on live TV, I turned orange. When I'm lying, I turn orange. So hopefully I haven't turned orange for you guys today. I don't know why you put a camera in front of me. I do really odd things with my fingers, but apparently I do. Here's angry Ryan. That was at the midst of the crisis in March 2023. Here I am on live TV taking a drink of water with Tyler Matheson. I had no idea I was on TV. So sometimes I don't even tell you you're on TV. But that's the final secret, little fun stuff about me. I'm going to get one drink. I'm going to drink of water. Look good. I'm going to get a drink here. We'll talk about bonds. Guys, bonds have had a really, really rough start to this year. One of the worst starts to year ever as yields have gone higher. Just remember this simple concept. When yields go up, you hear the 10-year yields going up. That tends to pressure bond prices, and bonds do not do as well. Last year, bonds actually were down for only the 4th time in history. LPL Research a year ago was saying we thought bonds could be flat to down. Nobody else is really saying that. The way that we managed our money, we said, hey, stocks would do really well, bonds wouldn't do as well. So we tilted. We took a little money out of bonds, put a little money into stocks, and it was a really, really good year for some of the money and some of the calls that we made. But just remember this: bonds have been bad, but it can always be worse. It can always be worse. Hopefully, I guess you guys are probably about to eat lunch, so I'm going to move that straight out of the Shawshank Redemption, right? So here you go again. We're almost done, I swear. Only 4 negative returns for bonds historically in history. This is the Barclays Ag. Think of it like your average bond fund, like the S&P 500. Some people say, oh, what stocks do today? Well, they mean the S&P 500, but then you can look and, like in the month of January, energy was up like 25%. Every other group was down, okay? So we're aware you can slice and dice it, but just broadly speaking, the Barclays Ag is your average bond fund. It was down last year. It's actually down several percent this year to start things off. We might change our view, but as of right now, we thought bonds would be flat to slightly higher for the year. After this tough start to the year, I mean, there could be some potential in some bonds that have sold off. We saw that last year. Bonds had a terrible first quarter. They held in there pretty well the rest of the year. So again, it's why you want to stay diversified. We still like stocks over bonds. We still think stocks will do better than bonds. When all is said and done, even if you start right now, we still think that's really the case. So why do you want to have bonds? Well, if I'm telling you stocks tend to do better than bonds, and we like bonds, why? The logical question is, why don't you just go all into stocks, right? It's a logical question. But here's my answer to that. Because people are crazy. Here's what I mean by that. Sir Isaac Newton said, and this is like 400 years ago, I can explain the motion of the heavenly bodies, not the madness of people. What I'm sharing with you now is a husband and wife, 1999, in Las Vegas. Of course, it's Vegas or Florida. All the crazy stuff happens in Vegas or Florida. They are in front of a judge. They are in front of a jury. They might be in front of their family, for all I know, divvying up their beanie babies. People are crazy. Stock markets are crazy. The economy can be crazy. This is why you want to keep some bonds in your portfolio, even though we don't like them as much as we like stocks. What I'm sharing here on the last slide is the pullback we tend to see in stocks and bonds. Stocks pull back almost 30%. We don't see that happen anytime soon. Some of the worst months ever. Bonds, 5 or 6%. Right? Bonds help you stay in your stocks. Remember I mentioned March 2020, bonds actually were down the first couple of weeks of the year. Well, they weren't down as much as your stocks were. I mean, if you've got a portfolio of all the Cathie Wood high flyers, yeah, you're not feeling probably very great, but it's why you want to stay diversified, why you want to work with your advisor, and you're all very lucky to have, such a great team helping you here. And again, you don't want to get all your eggs in one basket, all these things, all these sayings you hear about, but it's true. To reach your long-term investment goals, bonds can help you stay in your stocks because they're not nearly as volatile. And that's a real powerful instrument in our opinion. So kind of to wrap it up here, we still like stocks over bonds. We like the U.S. as well. I mentioned we like cyclicals, getting a little geeky. Bank loans, which have done actually really well relative to just about every other fixed income asset this year, is what we said, a couple months ago. Bank loans aren't as, how do I want to put it? They don't move as much when yields go higher like other areas of the bond market. Now, we said drop the baton emerging markets. To be honest, this is because we wrote this a few months ago. We're a little more neutral emerging markets here. There's some potential, but again, longer term treasuries and defensive areas like your utilities and let's see, utilities and healthcare and some of those staples, consumer staples. We don't like those groups quite as much. So in conclusion, enjoy the moment. All right, there I am with the Xavier University, who was ranked in the top 25, but not anymore. There's my son, Sebastian, and Susanna. Gus, the KFC guy, he wasn't there. He was younger. This was in, I think it was February of 17. We'll look it up. Whenever Xavier beat Villanova when they were #1 in the country, that's when this was. And that's my dad there. My dad passed away 4 years ago this past January. So again, I joke this is like we were in like the last row. The guy, he darn near had a heart attack just walking up there. But I know it was a really fun experience. So let's hope this bull market can continue. Let's hope we kind of shake off the rough start to this year like we think can. Economy does well. Maybe bonds can start to do a little bit better. But without our health, none of this stuff matters. So from everyone at LPL Research and LPL Financial and myself, I just want to wish everyone a happy and healthy and hopefully lucrative 2022. I got a couple more slides I got to show just because we live in a world of lawyers and compliance. All right, guys, hopefully I did okay there. Didn't talk too much. Let's do Q&A.
This was awesome, Ryan. Thank you. Thank you for doing this. I'm not sure why my video is not popping up there with you. So, it's interesting. As I was sitting here, I was thinking of all these questions that were coming through my head, and it was just about the time the question came into my head. I was like, there he goes. He just answered it. So we do have a question here in the chat. So do you believe that we're seeing a peak in inflation?
Yeah, thank you, David, for that question. We do. Now, I'll be honest, if you look at, the CPI number, right? That's the consumer price index. It just came out last week, came in over 9% higher than expected. We're probably going to see, David, the peak in CPI numbers next month, right? But again, that data comes out next month. It's like a month behind. So we think we're kind of right there. The more real-time data that we're looking at, when we look at those manufacturing data pieces, again, with time to delivery and input prices paid, those have peaked. I mean, those have now, believe me, over the last couple of years, they peaked before and then they go back up and they peak and they go back up. So it's early to say that everything is peaked. But again, I just think the Fed is, what's unique about the Fed? So Jerome Powell, for the longest time, was concerned about the job market, rightfully so. Now, the way the Fed works, he gets 4-year terms, okay? Now, a funny thing happened in November. President Biden, who gets to pick who's in charge of the Fed, said, okay, you've done a good enough job, Jerome Powell. You get 4 more years. As soon as he got the keys to the car, he changed his tune and started saying, you know what, now I'm worried about inflation. It's almost like he was waiting to get to do that. But now I like Jerome Powell. He's very upfront. The guy's on 60 Minutes all the time. He's not your father's Fed chairperson. He's saying he's worried about inflation. He's going to go after it now. And it might be uncomfortable for a little bit with the rate hikes that we're going to see and taking the pedal off the metal with the balance sheet. But again, that can be that typical volatility you see in a midterm year as well. You can always pick a reason why it happened. Just know that it tends to happen. So yeah, we are pretty optimistic that we're going to see the peak in inflation and the bottlenecks that we're seeing, sometime, if it hadn't just happened, likely over the next 6 weeks or so. Great question. Thanks, Dave.
Thank you, Ryan.
David.
So if you guys have any questions, you feel free to pop them into the chat or into the Q&A box there. So I have a quick question for you.
Sure.
So as with over the last couple of years, with all of the stimulus money that the government has been kind of handing out like candy to everybody and their brother, what's your view on income tax increases and what effect that may have on any kind of market?
Yeah. Well, the truth is, it's almost more surprising that we don't have higher taxes right now. President Biden ran on that. That shouldn't be much of a surprise, right? The fact that we've got a 50-50 Senate and the smallest majority in the House, like since Roe v. Cleveland 140 years ago, it's been tougher to kind of push some of those things through. But it was widely assumed that the corporate tax rate's 21% right now. 28% is what President Biden ran on. Most people thought it'd come in around 24, 25. I'll be honest, if you had told me a year ago that we'd still be at 21%, I'd said you're crazy. But that's exactly kind of what's happened. So it's tough to kind of get these things through. The checks and balances in Washington are how it works. But the truth, again, is to all this that we've done, all the stimulus, all the things we've done, we really do think that it makes sense to us that, some little bit higher taxes is probably going to be on the wealthy, honestly, corporate America and the wealthy. But we've taken a look, when you've had periods of higher corporate tax rates, periods of higher capital gains taxes, what happened? It's almost as simple as if the economy was fairly strong, the market took it in stride. Yeah, we hiked taxes in the 70s. Things weren't that great in the 70s versus in 2013 is a period when we hiked capital gains taxes. In 2013 was still early in a cycle. The Fed was accommodative. Stocks gained like 30%. So it's never that simple, but if the economy is fairly strong, it likely can withstand it. And honestly, that's what President Biden ran on. So it shouldn't be too surprising that we're probably going to see a little bit higher taxes here. But again, it's probably going to be on only the ultra wealthy and corporations, really. Yeah, great question though.
Another question back on interest rates, and we're going to put you on the spot, and we're going to take this to Vegas. In regards to rates, any thoughts on how high rates could go? And then here's a tough one for you: bets on how many rate increases this year.
Yeah, so this year, I'll go to the second part first, I guess. This year, Goldman actually came out last week and said 7 hikes. A lot of other people are saying 6 hikes. We're in the camp, it's going to be more like 4 or 5. Call us the low end of it. I think so much of what did Churchill said? Churchill said it's better to jar than war. What I'm getting at is I think a lot of talk. The Fed's got a lot of talk, and they're talking a tough game, rightfully so. And maybe they're saying if we talk a tough game, maybe that can almost be a psychological thing to try to get some of these inflationary concepts to slow down a little bit. So again, more like 4 or 5 hikes is where we're sitting. The second question: how high can they go? Yeah, I mean, so 10-year yield, let's call it 2% right now. I think it's pretty close to that. I think. We've got a range of at the start of the year between 175 and 2%. So I'll be honest, it's the top end of our range, but I think yields are going higher. And I think, potentially this time next year, we could be around 2.5 to 275 on the 10-year yield. And here's why. This isn't a U.S. story, guys. The 30-year yield in Germany just broke out. The 30-year yield in Japan just broke out. The 20-year yield in Switzerland, Swiss just broke out. U.S. yields are breaking out. It's global. There's a global phenomenon of higher trending yields. Now, the big question, right? We had a 40-year bond bull market, meaning rates went down for like 40 years. Is that over? Trust me, so many people have not done so well to say that and been wrong because it's continued to go. But I will say that we're seeing some major shift of what's going on. And honestly, in this world of QE, right, the world of QE that we've really been having since the financial crisis, what just happened during this sell-off? If you remember, stocks sold off. You guys know what yields did? Yields went up. All right, they've usually gone down every time as a safety trade. The QQQ, the NASDAQ 100, just big cap tech. Those have been the safety group that every time we sell off, that's where people go. Tech did not do that. We saw energy and financials actually do a little bit better this time. So there's some things going on that are a little bit different that have our interest. But again, if I see bank stocks making all-time highs, it's hard to think the world's about to end. The stock market would probably be sniffing some of that out. I don't know if I answered your question or I just went on a rant there, but hopefully some of that was good info.
So we had a question via email. Michelle, do you want to unmute yourself? And she's got that email.
Yeah, here we go. Okay. So he's saying, like many of my friends and family members, I know just enough about blockchain technology and cryptocurrency to be dangerous. As they both move forward globally and increasingly affect our day-to-day lives, what do you recommend in the way of common sense strategy perspective regarding these technologies? And is the US dollar likely to survive China's challenge to our dollar in support of cryptocurrency?
Okay. Oh, great question there. I'll put it this way: the U.S. dollar, we think the U.S. dollar is going to survive. I mean, I mentioned, during the crisis, that's where people flocked. I mean, Bitcoin got annihilated during the March 2020, right? The dollar didn't. So we've still got the world's reserve currency there. But I'll put it this way: I think it's a little bit like the bubble, right? In '99, Time Man of the Year, Jeff Bezos. You know what Amazon did a couple years later? It was down 86%. Now Amazon's a super company. These cryptocurrencies are going to be that way. There's going to be some major winners. I mean, nobody really knows how big it could be. And I'm somewhat limited to how I can discuss this. But what I can say is this: I didn't know in 1999 that my phone, literally right here, I could open my garage from it, right? I can lock my front door from it. I mean, no, you didn't really know that. You knew the internet was going to be big, and the way these cryptocurrencies and the way things could go, there could be a lot of opportunity there. No question about it. But there's going to be booms and there's going to be busts. And I'll tell you what. How many times has crypto, we'll say Bitcoin, how many times has Bitcoin had like literally a 20% drop on a random Saturday night? It's happened a couple times. It was just cut in half. A lot of these high flying cryptos just cut down 80, 90%. It bounced a little bit lately. So just be aware that, again, talk to your advisor before you do anything here. There's potential, sure. I mean, but boy, oh boy, is it risky. I mean, pets.com is a perfect example. Everybody thought pets.com was going to be this huge successful company. It really wasn't. It turned out to be Amazon.com, right? I mean, there's always winners and losers that are going to be in this stuff, but it's just kind of how we see things. Really, really unique situation, but there's some potential there.
Yeah, it's interesting, coming from a banking background like I did, I sort of have the view that anytime you mix humans and money and no rules, you're asking for trouble, right? No regulations. So I think that there's some interesting things to sort of be aware of with the crypto. So if you guys have any more questions, go ahead and pop them into the Q&A. And Ryan, it's interesting. I have one kind of final question for you that I have a tendency to be a storyteller like you and kind of pull out that there's so many things that we don't have control over, right? Yep. That as a financial planner and almost 25 years of doing this with folks is that I always tell people your attitude drives your actions and your actions drive your results. And sometimes the only thing you have control over is your own attitude, right? Mm-hmm. One of the things that I think has been interesting in being sort of a student of the markets, anyone who knows me, I can't control the stock market, but what I can do is help people kind of make good choices about their own behavior. One of the things that's been really interesting that I would love to just have you comment on kind of as to wrap this whole thing up is that it used to be that things going on in the world, like, the Ukraine-Russia thing or an impeachment of a president or, North Korea threatening to throw bombs across the planet or whatever that is, the stock market would just react violently and go down. It seems like in the last 5 years, 6 years or so, that the human race has become a little bit desensitized. And I just, that it doesn't seem like the markets react as much to the headlines as they used to. You would think that a global shutdown, a big giant, timeout that Mother Nature put us all in, and it only happened for about a minute, right? Yep. So I just, how does that play into this whole thing of financial planning and utilizing these tools of investments? Do you think that there's a little bit of that desensitization that's gone through? And then how do you, as a chief market strategist, kind of peel through all of that and really kind of keep things in perspective with regards to what choices for tools that we should be using?
Yeah, great questions there. A couple of them, really. I mean, we'll put it like this. I mean, there's no question that things went faster, right? Things are so much faster now, whether it be computers and different ways that the stock market reacts to things. We're getting bigger swings faster than we've ever gotten bigger swings before, and we bounce back just as fast. I've used this example before. JFK was tragically assassinated in November of 1963. The next 6 months was one of the least volatile and strongest stock market performances in the history of the stock market. Did anyone who hit their pillow that night, if they were thinking about their investments, really expect that to happen? Probably not. When I shared, I know I didn't share it very long, but all those geopolitical events, there are some really scary things that took place, yet stock market did okay. And this is going back to World War II. So is it almost as simple as if the economy's growing, you can withstand a lot? I think it is, but there's no doubt, all the news, and I do it too. I'm in the media. I think I've got a Reuters reporter calling me. I got to talk to somebody else. They love to make the news, so important and make it seem like everything matters so much. And I'm not saying it doesn't, but they've got a game too, right? And all the social media and the clicks and, my daughter, looking at TikTok and all the fast information overload is maybe a better way to put it. Sometimes just take a big picture look at things. And if earnings are growing and it looks like inflation is going to start to come back down and the economy is still fairly strong, those are the things that really matter more. And all the news, I don't want to ignore it, but it is sometimes there just to take your eye off the prize, in essence. and I've made a career leveraging media, so I don't want to talk bad about the media, but I do feel that there is absolutely some of that there. So great point. I'll finish it with this maybe. I think the smartest guys in the room are the credit markets, right? Credit default swaps, high yield spreads, junk spreads. To keep this real simple, there was stress in the credit markets before the tech bubble, way before the financial crisis. Actually, we started seeing some in January and February of 2020, before the worst of the crisis. And we're seeing a little bit of stress in credit markets right now, but nowhere near enough to say that it's a major risk on cycle. So we're still optimistic that the smartest guys in the rooms are still optimistic. Then we are also optimistic.
Well, and I think it all boils down to making sure that the tools are being utilized as part of an individual financial plan. And
Yes,
that's one of the
absolutely.
things that's really, really important. Really important to us is making sure that we're in. And Ryan, thank you. LPL has been a tremendous partner for us. I often say that LPL came into my world as an arranged marriage back in 2017. But it's been an incredible partnership, and having people like you on our team has been just an incredible value for all of us here at Strong Financial to be able to bring some of this to our clients. We really appreciate you being here with us today. I know you're busy, and thank you so much. For those of you that are on the call, Ryan will get us the handouts, and we'll make those available, as well as the recording of this session for those of you that might want to, have this to look at a little bit later. So thank you, Ryan. Thank you very, very much for taking an hour out of your day and being with us today. You have no idea how much we appreciate it. And so with that, ladies and gentlemen, we're going to go ahead and close this up. And again, thank you for being here, and we'll keep an eye out for you on TV, making those funny faces and funny facial distortions that you do. Right. So have a great day, everybody. Right. And don't ever hesitate to give us a call if there's anything at all we can be doing here to help or answer any questions you have. Thanks so much, guys. Have a good afternoon.
Bye-bye.
Bye.